Everyone's financial future is unique. But what is the common factor that can brighten everyone's financial prospects? Simple. Investing their savings. So let us find out whether investing your savings in the Kotak T.U.L.I.P plan will help you in the long term or not. Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision and to reach your financial goals in a more faster and smarter way. So now before analyzing this policy, let us first understand what is this policy is about. So Kotak T.U.L.I.P plan is a non-participating unit-linked endowment plan, and some of the key features of the policy are: you have the flexibility to pay your premium for a limited duration or throughout the policy term, and you have the option to choose from multiple investment strategies and fund options, and you can even enhance your financial protection of this policy through rider options. And there are loyalty additions as a reward for staying invested to enhance your maturity value on maturity. And you have the option to choose a high sum assured multiple to offer significant life cover, and there are 2x return of higher premium charges from the end of the 10th policy year onwards. So up to 3x return of mortality charges on survival starting from the 11th policy year onwards. So now let us take a look at the benefits available under this plan. So first you have death benefit, which the policyholder's nominee or the legal heir will get in case the policyholder unfortunately passes away during the policy term. So out of the three options presented on the screen, whichever is highest at the date of death of the policyholder, that will be given as a death benefit to the nominee or the legal heir. So maturity benefit is something the policyholder will get once the policy matures. Here he will get the fund value, which is your main account plus top-up account if you had any, inclusive of loyalty additions, shall be payable as a maturity benefit to the policyholder. And now some of the fund options of this policy are Classic Opportunities Fund, Frontline Equity Fund, Kotak Mid-Cap Advantage Fund, Kotak Manufacturing Fund, Balance Fund, Dynamic Bond Fund, Dynamic Floating Rate Bond, Dynamic Gilt Fund, and Money Market Fund. And all these fund options are categorized based on the asset classes they are in, like equity, debt, money market, and also according to the risk profile they have. And let us take a look at the charges available under this plan that you need to pay, which are premium allocation charge, policy administration charge, fund management charge, which will depend on the fund option you have chosen and the risk profile it has. So higher the risk profile, higher the charges would be. And it also has a switching charge of 250 rupees, which will be charged for every additional switch after the first 12 switch policies in a year are used up. And you also have partial withdrawal charge. So first 12 charges in a policy year are free, thereafter 250 rupees will be charged. And you also have discontinuance charge, mortality charge. So the thing is, though the plan allows you to invest in market, the various charges as discussed above, as discussed in this video, will be deducted from your premium amount. So other market related products don't levy these charges. So over a period of time, these charges will pull down your returns, which will be a drawback that you need to consider before deciding to invest in this policy. Now let us take a look at the advantages and disadvantages of this policy. So the advantages are: you can enhance your policy protection with critical illness and accidental death cover, and you get 2x return of your premium allocation charge and up to 3x return of your mortality charges. And you can also increase your investment contribution with a top-up premium as and when you have surplus money. And you have the option to decrease your sum assured without change in premiums, and there are 12 free switches and 12 partial withdrawal after 5 years are allowed. So these are the advantages present in the policy. The disadvantage is there is no liquidity in the first 5 policy years. Though the plan invests in the market, the returns are not up to the mark. So these are some of the disadvantages of investing in the policy which you need to carefully consider before deciding to invest in it. So now, as we have a basic understanding of this policy, let us now move on to the analysis part of the video, where we are going to evaluate the IRR, internal rate of return of this policy, to determine what kind of returns we get at the end of the day. Because no matter the benefits or the advantage, what helps in choosing a policy is the returns we get at the end of the day. So just for calculation purpose, let us assume that a 35-year-old male opts for this policy for a sum assured of 1 crore. The policy term is 20 years and the premium paying term is 10 years. The annualized premium is 2 lakhs. So this policyholder is eligible for the fund value as on the date of maturity. So the values present here are based on a assumed investment rate of return of 4% and 8% per annum respectively, marking the worst and best case scenario, just to give you an idea how this fund can perform in worst and best case scenario, because this fund invest in the market. So just to give you an idea, but these values we have mentioned on the screen is not guaranteed, and they are not upper and lower limits of what this policy can give you. So they are dependent, so the policy's performance is dependent on a number of factors including future investment performance. So no way these 4% and 8% represent the only possible range of outcome in this policy. So because it can depend on a number of factors. This is just to give you an idea on worst and best case scenarios. Here the fund value at the end of 20 years at 4% scenario is 22.34 lakhs. The IRR calculation for this cash flow results in 0.72%. This rate is not even close to your bank savings account interest rate. And the fund value at the end of 20 years at 8% scenario is 43.37 lakhs. The IRR for this cash flow results in 5.05%. This rate is less than the bank's fixed deposit interest rate. So investing in this policy will not help us aid in wealth accumulation, and the plan also doesn't offer us liquidity. This is a long-term investment, but the plan fails to beat inflation. As we know that this policy is not giving us the desired outcome we need, now we are going to take up an alternative investment approach, where instead of investing in an insurance cum investment policy like this, we are going to separately invest in insurance and investment, just to see whether it can yield us better returns and offer us better opportunities in the long run. So let us assume the figures mentioned in the Kotak plan as a parameter to compare this policy for a fair comparison. So let us opt for a pure term life insurance policy for life cover purpose for a sum assured of 1 crore, but it would only cost as a 24,100 rupees per annum premium, and the policy term is 20 years and the premium paying term is 10 years. For the same sum assured, we paid 2 lakhs per annum under the previous example. So in this alternative investment strategy, you will be left with 1,75,900 rupees for your investment. For comparison purpose, let us assume the balance amount is invested in another market related product, which is an ELSS fund, which also has tax saving purpose. At the time of redemption, the fund value is subjected to capital gains tax, and you can see the tax calculation mentioned on the screen. So the pre-tax fund value is 1.07 crores. The post-tax fund value is 96.30 lakhs, which is double the time of fund value at the 8% scenario of Kotak plan. This fund can be utilized for achieving any of your life's financial goal. The IRR for the pure term and ELSS combination results in 10.39%, which beats the inflation rate, and the returns are much higher than the Kotak plan. So what is the final verdict? Should we invest in Kotak T.U.L.I.P plan or not? Is it worth investing or not? As you can see, this policy has two basic aspects covered, which is the insurance and investment. But the insurance cover, which is the sum assured, is quite reasonable to protect your family's future needs. But the premium they charge for the sum assured is enormous compared to a pure term life insurance policy. So the excess premium is supposed to be invested in the market, and the maturity value is paid to the policyholder. The potential return on investment is not convincing for a long-term investment. So the reason for these low returns is hefty charges and high agent commission. If you are interested in market linked product, you can do so without clubbing it with insurance. This way you can combat inflation and accumulate wealth for your life's financial goal. And building a diversified investment portfolio and having a separate term insurance to protect your family will keep your financial plan on track. If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.